Welcome to my YouTube channel, The Executive Outcomes. My name is Michael Mwansalyoba. I'm here to take you through financial accounting on accounting concepts. Today's presentation outline will cover the following: about accounting concept. We are going to look at the separate entity concept. We'll look at the money measurement concept. We'll look at the going concern concept, followed by the accruals or matching concept, consistency concept, separate valuation principle, materiality concept, neutrality concept, accounting period concept, realization concept, and we're going to look at historical cost concept. Let's start with the entity concept. This concept states that the business and owner should be treated separately. The importance of this concept is crystallized in this particular example, where, for instance, when the owner withdraws cash, is treated as an outsider. Let's look at money measurement concept. The money measurement concept is an important accounting concept that is based on the theory that a company should be recording only those transactions that can be measured or expressed in monetary terms on the financial statement. The practical aspect of this can be seen in when they look at the financial statement. It comprises of a list of assets in the statement of financial position that is presented in dollar values or kwacha amounts, if it's looking at, for instance, the Zambian currency. So that is the practical aspect of this money measurement concept. Let's look at the going concern concept. Under going concern concept, we can say that the assumption that is made for the business is that it will continue in operational existence for the foreseeable future, and that there is no intention to put the company or entity into liquidation unless otherwise it is known. What is the practical aspect to this? You find that when it comes to profit, these are calculated periodically as the business is taken to have an indefinite life. We don't wait until we come to the end of the business to calculate how much the business has given totally or in total as profit. So this is what can be said about the going concern concept. Out of the prudence concept, this concept refers to a critical or a crucial principle applied in accounting to ensure that income and assets are not overstated in the financial statement. It is alternatively called or known as the conservatism principle, as it is there to be regarded as we make sure that the liabilities are not understated and provisions are made for income and losses. So what is the practical aspect of this prudence concept? The practical application can be seen in this example relating to stock. Stock may immediately be valued below cost if it is thought a loss will be made when eventually it is sold, not when or not until it is sold. So immediately you see that a loss is about to be made or will be made, you can actually scale down or value that stock accordingly. So that is the practical aspect of prudence concept. Let's look at another concept. In this particular case, we're looking at the accruals or matching concept. What can be said about the accruals and matching concept? A number of points can be noted here. One is that the accruals principle is an accounting concept that requires transactions to be recorded in the time period in which they occur, regardless of whether the actual cash flows for the transaction are received or paid. Again, we notice that this states that in computing profits, revenue earned must be matched against expenditure incurred in earning it. So that's what can be said about accruals concept. So when you look at, for instance, the income statement, we look at all the revenue that is actually earned and match it against all the expenses that has been incurred to report the result of those particular business activities, so which can end up being a profit or a loss. So in this regard, we notice that we don't only look at the actual cash inflows and actual cash outflows. We look at what has been earned, what the business has been entitled to receive in a particular accounting period, and what has been incurred. In short, we are looking at what are the obligations, okay, that are supposed to be discharged or the related to the business. What obligations has it acquired that has needs to be made good in that particular accounting period. So when we match the two, we end up having either a profit or a loss. We move on to look at the consistency concept. Under this concept, we can say that this concept states that in preparing accounts should be consistent, making sure that certain items be treated using different methods, and the methods adopted should be used consistently from one year to the next, so that reasonable comparisons can be made and reasonable conclusions made, which can be bordering on assessment of the performance of the business. So there is need to have the consistent concept applied, so that it adds value to our financial statements by being comparable from period to period. One of the examples that can be related, practical example that can be related to consistent concept, is when it comes to depreciation or stock valuation. There is need to be consistent in the way you treat or the way you calculate depreciation. There are several methods of depreciation. You can have straight line method, you can have reducing balance method, sum of digits method, and so on. Now you find that if you apply one model, the amount of depreciation that you are going to come up with might be different from another model. And for depreciation, it being taken to be expense in a particular accounting period, you find that if you calculate depreciation using one model, the amount might be smaller than the depreciation amount that is calculated using another model, meaning that the value of the total expenses can be affected, and of course the bottom line, which is the profit, ultimately can be affected. So if you keep on changing the way you calculate depreciation, that will affect the reported results in that manner, because the bottom line will be actually be affected. So there is need to be consistent with a particular policy per se on depreciation, or particular policy per se on stock valuation. For stock valuation, they have several methods of valuing stock. Okay, one can be using first in first out method, or others can be using average cost method. Again, you find that these two will have an effect on the reported profit because of the principle or the policy that you have adopted. In this regard, for us to let the financial statement to be comparable, there is need to be consistent, whereby we apply the policy, same policy year in, year out. Of course, the circumstances of business can change, where maybe the previous policy needs to be changed. In that regard, the accounting standards require us to quantify the effect of those changes. If you are going to change over from one particular accounting policy to another one, you need to disclose what effect that will have on the financial statement. We move on to look at separate valuation principle. For separate valuation principle, we can say that this is where a recording and measurement rule comes to effect, and this relates to the determination of the aggregate amount of any item. In order to determine the aggregate amount of an asset or liability, we take it that each individual asset or liability that comprises the aggregate must be determined separately. So we look at the next accounting concept. This is materiality concept. Under materiality concept, a number of items can be looked at. The first one is to know that all material items should be reported properly in the financial statement. Okay? Material items are those items whose inclusion or exclusion result in significant changes in decision making for the users of business information. So that's what can be taken to be material. We also look at the next, which is substance over form. What can we say about substance over form? It's important to note that the legal form can differ from its real substance of a transaction. Where this happens, okay, accounting should show the transaction in accordance with its real substance. What is a practical example that can assert this? Let me look at the aspect of how we acquire asset using finance lease. When you acquire an asset using finance lease, you will find that you record in the statement of financial position the asset amongst the non-current assets. But you notice that under finance lease, the property in the asset will only be transferred to you after paying the last installment. So, provided that you have acquired this asset under finance lease, even when you have just made the first payment, because your intention is finally to actually convert the asset into your own, then we take it that there is need to actually show it as your own asset in the, or recognize it in the financial statement as one of the non-current assets belonging to the business. So that is where we talk about substance over form, where in this case, as I've said, the legal form has differed from the real substance, but we find that the substance, okay, well, here the substance will be looked at more important than the legal form in terms of making a decision as to whether to recognize the asset into the books of business or not. So we move on and look at the neutrality or objectivity concept. For objectivity concept, this is a principle that financial statements of an entity be based on solid evidence. Okay, the idea is to make management producing financial statements that are not slanted by their opinions and biases. So it governs this particular aspect by making sure that management are prevented from coming up with financial statements that are tainted by their opinions and biases. So we also look at another concept. This is the accounting period concept. The accounting period concept states that there must be a standard shorter period in which to measure performance of a business. Normally, 12 months period is adopted for this particular purpose. This reference period is known as the accounting period. We also look at the realization concept. Under realization concept, the following can be said: that the profits are realized immediately goods or services exchange hands, whether cash has been paid or not. We also look at the historical cost concept. For the historical cost concept, this states that assets should be recorded in accounting books at cost. That is, the price paid to acquire them. These assets are systematically reduced by a process called depreciation. For instance, if you're looking at land can be bought for 20,000, and this value will remain in the books of accounts even if at the time you are looking at this particular record, the same land can be sold, for instance, at 100,000. So thank you for listening to my presentation on accounting concept. Please don't forget to subscribe to my channel and like my video. We are going to look at other interesting topics under financial accounting. If you have any topic or suggestion which you want me to cover, please feel free to make suggestions and I'll prepare that presentation for you. Thank you for listening. I hope to be with you again and continue with our presentation, which we are going to enjoy again.